Hey investor friends, I'm Michelle Markey, and as we're hitting the twilight days of summer, it's late August, and you may be wondering if we're out of the woods with Alibaba seemingly hitting rock bottom at around $153 a share off its high in October 2020 of $317 a share. So that's negative 51.7%. And if you were basing your margin of safety price on that alone, maybe it's on sale. But then again, none of this is investing or financial advice because I'm just some person on the internet, but I'm always trying to seek wisdom and truth. So I'd love if you could please like and subscribe to my video and YouTube channel because it greatly helps out with the YouTube algorithm, and because I'm happy to share what I've gathered in terms of what are some of the latest super investors up to with Alibaba, and what are some of the activities going on lately with US and Chinese regulatory rumblings going on, and then what's Alibaba also been up to in terms of some of their financials, what could be some of the risks with being invested in a VIE ADR structure, and also some other things that we should just keep in mind as we consider if this might be an investment opportunity or not. So I hope you enjoy what I'm going to share with you today. Given that Mr. Market is highly volatile sometimes, at the time I'm recording this video, Alibaba had closed at around $171 a share, and that's up around 18 bucks from its recent low of $153 a share. And based on a technical indicator, when it was at $153, it came in at a slow stochastic of 1.69, and this was super low within the oversold territory. Like anything at 20 or below is really oversold. So we can see that having come up to around 171, it's hovering around the 20, still pretty oversold, but starting to recover from that recent low. So this might be why we could be seeing out of the woods indicators for Alibaba to start being on an uptrend for now, but that's not any reassurance to anyone. If anything, you should be very aware of what game you're playing. And to borrow from a Warren Buffett poker analogy, he says that indeed, if you aren't certain that you understand and can value your business far better than Mr. Market, you don't belong in the game. And as they say in poker, if you've been in the game 30 minutes and you don't know who the patsy is, you're the patsy. So just keep this in mind. As Warren Buffett said in 1987, none of us want to be the patsy at a poker game, and definitely not when it comes to how we're trying to evaluate stocks. Speaking of Buffett, he doesn't seem to have joined the buying spree in the last couple of quarters that made Alibaba the top two of the last quarterly buys from Q1 2021 through Q2 2021, which is through June 2021. And he hasn't joined his best friend and vice chairman of Berkshire Hathaway, Charlie Munger, nor Monish Pabrai, Guy Spear, Bill Miller, nor Thomas Russo in buying Alibaba. And Dataroma tracks 72 super investors, and we've seen this increase from Q4 2020 from 6 out of 72 to 8 in Q1 2021 to now 11 out of 72, which is 15% of super investors that Dataroma's tracking have all bought into Alibaba. So I don't know what Buffett is waiting for, but it seems like a bunch of well-known and respected investors are buying up this stock. As much as it feels like Christmas in July and August, much as like how Santa may have overindulged in cookies and milk, maybe Charlie Munger has had his fill of Baba, as he only had Daily Journal Corporation buy some in Q1, but that didn't stop some of my other favorite investors, Monish Pabrai and Guy Spear, from buying Baba in Q2. And Monish Pabrai upped his stake to a full 21% of his American portfolio, at least, per the 13F filing that Dataroma pulled in. And if his assets under management are actually much greater, like to the tune of at least $638 million, then his current stake in Alibaba might actually be a lot less than it seems, at maybe closer to 9.2%, which might be, if his capital allocation strategy is correct based on internet sources I found, if you watch my Got Cash video and I recap what that's all about. But based on some of that, he might be valuing Alibaba to be maybe a 3 to 4 bagger based on having a stake in up to 10% of his assets under management. But we'll see if he has even more assets under management, and if Alibaba's only a 5% stake, then maybe he thinks it could be a five-bagger, but who knows? And then with Guy Spier, he has a respectable 5% stake in Alibaba in his portfolio based on the 13F that Dataroma shows. So I think that that's pretty awesome that he bought in, and as much as Monish Pabrai is willing to go really far out and see where this will take him, I think that Guy Spier is taking a more cautious approach to jumping in a little bit, but not jumping into the deep end of the pool. And then you may be wondering what's so tricky about Alibaba's VIE ADR structure. And just to explain some of the definitions, ADR means American Depository Receipt, and it's what allows foreign equities to be listed on American stock exchanges. And then when it comes to ADR and ADS, that's just American Depository Shares, which represents the US denominated stock share that people can buy on American exchanges of the foreign equities. So let's say we're buying AstraZeneca's stock. We would plug in AZN and it will be on the NASDAQ stock exchange, and then we can buy the AstraZeneca ADR. And then when it comes to a VIE, which stands for Variable Interest Entity, Alibaba has to have a shell company in this kind of format in order to be able to list as an ADR in an American exchange, so that foreign investors would be allowed to technically only buy into the shell company as a way of sort of indirectly trying to stake claim to the profit and assets of Alibaba in mainland China. But actually, in order to have a workaround, because the Chinese government or CCP says that only Chinese citizens can actually invest in Chinese companies, therefore, to be able to offer these Chinese companies to the outside world, it has to go into this VIE structure. So it's a little bit tricky because none of the foreign investors actually have a true claim to the real Chinese company. There's this complicated structure where the VIE is either located in the Cayman Islands or British Virgin Islands, so that foreign investors can be invested. But it's a little bit up to debate if it can be really enforced, that if rules were to change and VIE structures were to fall apart, if foreign investors would be able to get their money out of these equities that they kind of invested in, but which may not be truly based on the real underlying business. So it's a little bit difficult to see where things could go, but VIEs have been around for at least 20 years, with the first one being Sina.com listing on the NASDAQ in 2000. So there's historical precedent for this to have stayed around for at least a couple of decades. So the hope is that it will continue to stick around. I know for a long time that Charlie Munger didn't trust the VIE structure, but apparently over time he's become okay with Alibaba's VIE structure, and we can see that they've got a bunch of offshore companies in the Cayman Islands and then 1,000 miles apart in also the British Virgin Islands. So that's a nice little geography lesson for any of us who want to check out where these islands are. But as with anything, we should do our due diligence and check out any and all of the risks that could be associated with this corporate structure, and really understand what we might be getting to if and when we choose to invest in any VIE type company. Of course, what's been hammering the stock prices of many Chinese companies lately has been the concern with regard to changing regulations. And this could be coming from both China clamping down on offshore listings, so maybe that's scaring some newer companies from wanting to list right away until they wade their way through some of these changing regulatory waters. And the same thing from US regulators, where the SEC might want to look at some of what's going on with the VIE structures, and there's plenty of articles outlining some of the concerns with some of the VIE structures and what foreign investors could be really invested in. For example, Yahoo was a cautionary tale when they invested in Alibaba in the mid-2000s, and then things didn't work out for that investment for them. So it just shows that we should be very mindful about what some of the regulatory changes could be, but to not necessarily let that scare us. In classic brinkmanship between the US and CCP, regulatory rumblings have been escalating over the years, so much so that Alibaba Chief Financial Officer Maggie Wu assured investors last year that Alibaba wouldn't get delisted. And some of this is because of what the US Senate passed last year and which went into effect in December 2020, called the Holding Foreign Companies Accountable Act, in which it expects foreign companies to provide to the Public Company Accounting Oversight Board its audits, and if it doesn't do that in 3 years, and if there are also entities representing the Chinese government that are owning or have a controlling financial interest in the foreign company, that this needs to be reported to the US SEC, and if it doesn't comply enough, then maybe there could be some outcomes like of a potential delisting. So that's why there's been some concern about whether Alibaba would be able to or willing to comply with some of these changes going on in terms of what the US government is expecting in terms of audits. But we know that based on the CCP and looking out for its own national security interests, it doesn't want to easily hand over data about its companies in China. So Alibaba is in a little bit of a tough spot because, of course, I'm sure it wants to comply with as many regulations as it can, but it definitely makes it have to walk carefully between the lines that it's walking. And although Alibaba is doing a pretty okay job because it's following the US generally accepted accounting principles or GAAP rules. So that's kind of helpful because it makes it easier for foreign investors like myself to try to evaluate what might be the potential value of this company and what price should I pay for it today if I were to buy some. And so we'll see what shakes out, but most likely there will probably be some level of compromise because I don't know if Alibaba will be able to fully comply with what the US government is expecting. And if it doesn't do that for 3 years in a row, then it could risk being delisted. So we'll see what shakes out. Over the last year, it's been easy to be sucked into the negative news about what's going on with Chinese companies. And if we read some of these opinion articles, there could be some truth to them, but it could also be exaggerating things. So we also need to consider, has anything changed in the fundamental core of the business that has maimed its durable competitive advantage and put it at a disadvantage for future growth of its earnings and cash flows as a business? So we need to critically think about some of these factors. And while it can be interesting to consider some of these opinion articles, they're just opinions and we all need to form our own conclusions. So with that, we need to think about, what does it mean when there's an article coming out saying that the Chinese government has passed one of the strictest data privacy rules, and maybe it's comparable to the European Union's GDPR rules. Who knows? But we need to consider if that will seriously change the way that some of these internet companies in China might make money, or if it's just another thing that they need to incorporate into the way they do business and then move forward. And basically what one article summarizes the new privacy changes to mean is the government is saying that future growth will only be possible within the limits of what is good for the Chinese nation. And so with that being said, let's just remember that what the CCP is trying to do is make the country and economy better for all of its people, not just for some of the wealthier big tech companies and people who are in the fortunate position to run them. So with that in mind, we could be seeing the noise with a lot of ed tech companies and converting them into nonprofits. But maybe that's also because a lot of middle-class Chinese people haven't been able to get their children to get after-school tutoring, and if it's becoming more and more expensive to do this, that's letting people fall behind. So maybe that's part of why there's some regulatory changes happening in the ed tech space, but maybe those companies aren't dead for good. As much as if you look at the stock market, you might think that they've been left for dead, but maybe there is hope. Maybe we're overreacting to some of the regulatory changes and maybe they'll recover. But it just goes to show that we could be treating things way out of context as to what's the reality of what's really going on. And maybe it's a little bit early to tell what the full extent of regulatory changes will hold in the future. To touch on a few financial points that stood out to me, as many people know, Alibaba was hit with a $2.8 billion antitrust or anti-monopoly fine because it tried to make some of its merchants only sell their goods on Alibaba's platforms, and if they found that they were listing them in other platforms, then maybe their search results would be lowered in Alibaba's platform. So that's why Alibaba got into that kind of hot water. but that probably served as a pretty good learning lesson because, as we can see with the sad picture that New York Times had of Jack Ma, it seems that Alibaba has accepted the penalty with sincerity, and they want to be able to see their industry adopt some of the normative practices that the CCP is expecting. And to me, that's kind of code for, whatever the CCP wants as it may be growing towards its goals for the internet. This is kind of new for the big tech industry in China because it's not like these Chinese companies have been listed in US exchanges for as long as some of the American big tech. So it could kind of be a little bit of a wild west as to how far can big tech get away with in China before they get reined in by the CCP. And Alibaba discovered that in a little bit of a hard way because the last time that there was a major fine that was slapped to Qualcomm in 2015 for $975 million. So this is almost triple that. So I'm sure Alibaba will think twice before they try to pull any monopolistic maneuvers again anytime soon. And despite being slapped with a $2.8 billion fine, they still brought in an income of $13.7 billion, and that's pretty decent. And it seems that they're pretty confident about their long-term growth because they've increased their stock buybacks from $10 billion to $15 billion. But then on the slightly not fun side, they've been enjoying lower tax rates of around 17.7%. And by next fiscal year, 2022, that may be increasing to 23 to 25%. So maybe we'll see a little bit less growth in the short term, but they seem to be confident about their long-term earnings potential. Finally, in addition to evaluating a company's quantitative performance, we should also look at qualitative factors like CEO Daniel Zhang's letter to shareholders and evaluate it on criteria of candor and honesty and transparency. And a useful guide to be able to show us how to analyze these letters for a level of candor is from Laura Rittenhouse's Investing Between the Lines book. I find this really helpful to be able to judge whether I think a CEO is believable. So we can use this type of resource to analyze if a company is telling the truth and see if it makes sense to us, what the head of the company is saying to us, and if we can believe in the future of the company. And if the company like Alibaba can earn the shareholders' invaluable trust, as Daniel Zhang put it. And if you enjoyed this video or learned something, please like and subscribe because I greatly appreciate it, and thank you for watching. Till next time.